A 9% dividend yield, that's what you see on your screen. A stock paying you 9% every single year just for owning it. So you throw your savings at it because that's free money, right? That's passive income, that's financial freedom. Except 6 months later, your investment is down 40%, the dividend got slashed in half, and you're sitting on a loss that'll take you years to recover from. Today, I'm going to explain exactly why this happens, how to spot it before it happens, and the one number you need to look at before you ever buy a dividend stock. And trust me, it's not the yield. Okay, let's start with what dividend yield actually is, because I think a lot of people get this twisted. Dividend yield is just the annual dividend divided by the stock price. That's it. So if a company pays $4 a year in dividends and the stock costs $100, the yield is 4%. Now here's where people get caught slipping. When a stock price drops, the yield goes up, automatically. The company didn't decide to pay you more. The stock just got cheaper. So that 9% yield you're drooling over, it might exist purely because the stock is in free fall. Let me paint a picture. Say you've got 40 grand saved up and you want passive income. You find a stock yielding 9%. You do the math in your head. 40,000 times 9%. That's $3,600 a year. $300 a month. You're pumped. But here's what you didn't check. The stock is down 60% over the past year. The company's revenue is shrinking. Their debt is climbing. And analysts are whispering about a dividend cut. But none of that shows up in the yield number. The yield just sits there flashing 9%, looking sexy. This is what investors call the dividend yield trap. And it has wrecked more portfolios than any crypto scam ever will. So let's talk about why companies even offer high yields in the first place. Because sometimes a high yield is legitimate. Real companies, solid businesses can pay out a lot of cash. But there's a huge difference between a company that's sharing profits and a company that's desperately trying to keep investors from leaving. See, when a stock price craters, a company faces a brutal decision. They can cut the dividend, which tells everyone things are bad and causes even more selling. Or they can maintain the dividend, pretend everything's fine, and hope nobody notices. And here's the dirty secret. Some companies will actually borrow money to pay their dividend. Let me say that again. They're taking out loans to pay you. That's not income. That's a Ponzi scheme with better marketing. Now let's look at some classic examples. Back in 2014 and 2015, oil prices collapsed. A bunch of energy companies that had been paying solid dividends suddenly found themselves bleeding cash. But instead of cutting their payouts immediately, they kept them going. Their yields shot up to 10, 11, even 14%. Investors piled in. Free money, right? And then the cuts came. One after another. Dividends slashed by 50, 70, even 80%. Stock prices kept falling. And the people who bought for that juicy yield, they lost half their money and watched their income disappear. This pattern repeats constantly. Real estate investment trusts, telecom companies, shipping stocks. They all go through these cycles where the yield looks irresistible right before the collapse. So how do you actually protect yourself? How do you tell the difference between a genuine high-yield opportunity and a trap that's about to snap shut? There are 3 things you need to look at, and yield is not one of them. Number 1, the payout ratio. This tells you what percentage of the company's earnings are being paid out as dividends. If a company earns $1 per share and pays out 70 cents, the payout ratio is 70%. That's healthy. They're keeping 30% to reinvest in the business, pay down debt, build a cushion. But if the payout ratio is over 100%, that means they're paying out more than they earn. They are literally distributing money they don't have. That is a massive red flag. A company cannot pay out more than it earns forever. Math doesn't allow it. Number 2, free cash flow. This is the cash a company generates after paying all its expenses and maintaining its business. It's the real money, the money that actually exists. Because here's the thing, earnings on a financial statement can be manipulated. Accounting is creative, but cash is cash. If a company has strong, consistent free cash flow, they can afford their dividend. If free cash flow is negative or shrinking while the dividend stays the same or grows, that yield is a mirage. Number 3, and honestly, this is the one most people skip. Dividend history. You want to see a company that has paid and ideally grown its dividend for at least 5, preferably 10 straight years, not just through the good times, through recessions, through market crashes, through pandemics, because here's what that tells you. Management prioritizes the dividend. It's part of their DNA. They plan for it, they protect it, they don't treat it like an afterthought. Compare that to a company that just started paying a dividend 2 years ago, set it artificially high to attract income investors, and has no track record of maintaining it through tough times. That's not income, that's bait. Now let me give you a framework, something practical you can actually use. When you look at a dividend stock, check these boxes first. Payout ratio under 75%, positive and growing free cash flow, at least 5 years of dividend growth. And honestly, a yield in the 2 to 6% range, I know, that sounds boring compared to 9%. But boring is what keeps your money safe. Because here's the truth that nobody on Finance TikTok wants to tell you. A sustainable 4% yield with annual growth will outperform a 9% yield that gets cut in half after a year. Every single time. Let's do the math. You invest $10,000. Option A, the boring 4% grower. In the first year, you get $400. But the company grows its dividend by 8% annually, which is pretty standard for quality dividend growth stocks. By year 5, you're collecting over $540 a year. By year 10, it's nearly $800. And if you reinvested those dividends along the way, you're now earning over $1,000 a year on your original 10 grand. Option B, the 9% trap. You get $900 in year 1. Feels amazing. But the company cuts the dividend by 50% in year 2 because they were overextended. Now you're getting $450, and the stock price has dropped 40% because the market panicked. So your $10,000 is now worth $6,000. Your income got halved. And even if the company recovers eventually, you spent years underwater when you could have been compounding safely. This is why chasing yield is one of the most expensive mistakes you can make as an investor. It feels smart. It feels safe. You're collecting income, but you're actually buying a deteriorating asset. So let me summarize everything into one rule. Dividend yield tells you what already happened. It's the stock price and the current dividend mixed together. It is a result. It is not a strategy. A high yield can mean the company is generous, or it can mean the company is dying and the market knows it. You have to look underneath. Payout ratio, cash flow, history. Those 3 things will tell you whether that yield is a promise or a warning. And look, if you remember nothing else from this, remember this. When a dividend yield looks too good to be true, it almost always is. The market is not stupid. If a stock is paying 9, 10, 11% and smart money isn't piling in, there's a reason. Your job as an investor is to find out what that reason is before you hand over your money. Start with sustainable yields. Build your foundation. Let compounding do its thing. And when you spot a high yield that actually passes all 3 checks, then you can consider it a bonus, not a starting point. If this was helpful, there's more on the channel about investing, money, and building real wealth without the gimmicks.